Hi folks, welcome back to Murthy Finance Academy. What if I told you there's a company that's debt free, holds a dominant position in a high barrier niche, and has a massive 30% return on equity, at its cash flow just went negative. So today we are diving deep into the Q3 fiscal year 2026 results of Blue Jet Healthcare. It is a specialized CDMO powerhouse that doesn't make basic pills. They are deeply integrated into the global supply chains of the world's biggest healthcare giants. But right now, they are crossing a destocking bridge that has investors nervous. Is this a quality discount or a falling knife? Let's peel back the layers. So, Blue Jet isn't your average pharmacy shop. They operate in three specific areas. Contrast media intermediaries, this is their bread and butter, making up nearly 68% of the revenue. These are critical components for X rays, CT scans, and MRIs. Second, high intensity sweeteners, a legacy business where they were a first mover in India for saccharin salts. Third, pharma intermediaries, PIs, pharma intermediaries and APIs. So their high growth engine focused on chronic diseases. Their moat is incredibly sticky. They are the preferred supplier to the world's top four contrast media players. In this industry, switching suppliers is a multi-year regulatory nightmare. Once you are in, you are in. So despite that moat, Q3 was losing. Let's look at the numbers. Revenue down to 192.4 crores from 318.4 crores a year ago. So there is a 9 to 10 month. If you see the EBITDA margins, sorry, if you see the EBITDA margins, it smashed from 39% down to 24%, and the culprit a 40% year-on-year decline in pharma intermediaries. So why the drop? It's a classic destocking crunch. There is a 9 to 10 month lag in their supply chain. Customers are clearing their own shelves before ordering more from Blue Jet. Meanwhile, their sweetener segment is facing heavy price erosion. So here is where we need to look at the anatomy of the cash. Blue Jet is sitting on a 410 crore cash fortress and is completely debt free. Sounds great, right? But look closer. The CFO to PAT ratio is the major red flag. Despite reporting a profit of 40.2 crores, their cash flow from operations was negative 0.8 crores. Inventory days have spiked to 290 days. Money is tied up in for nearly 9 months in the cash conversion cycle. Essentially, their profits is paper only right now, locked away in dusty inventory and unpaid receivables. So management isn't backing down. They are calling this as a recovery bridge. They have approved a massive 1,000 crore Vizag facility and a new R&D center in Hyderabad. They are even hiring European strategic consultants to help them navigate the CDMO space, which actually hit their current margins. So they are betting big that demand will explode again, essentially with 20 active RFPs in the works for things like weight loss drugs, GLP-1. But there is a threat on the horizon. A new drug class called obicetrapib could eventually compete with their bempedoic acid business. So if you see currently their valuation is at around PE of 23.7. Blue Jet is trading at a quality discount compared to its peers, generally which trades at nearly 25 to 35 times. You are getting a high ROE, debt-free company at a fair price, but you are paying for a future that hasn't arrived yet. So if you are watching this talk, here is your checklist for 2026. Revenue recovery. Do orders normalize by Q1 fiscal year 2027. Second, cash flow. Does the CFO to PAT ratio move back about 0.8 times? Third, the big projects. Watch for the Bhumi Puja of the Vizag plant this February. Hopefully by now it should be done. And the validation of Mahad Unit-3 in Q1 fiscal year 2027. So Blue Jet has the machines and the people ready. They just need the world to start clicking buy again. So what do you think? Is the negative cash flow a deal breaker, or is this is the perfect time to buy the dip before 2027 recovery? Let me know in the comments. So generally, Blue Jet is trading at a significant discount compared to the industry giants like Divi's Laboratories, which generally trades at around 67 or 66. So the market is pricing Blue Jet like a struggling chemical company, even though its ROC of nearly 25 to 30% is nearly double than that of Divi's Laboratory right now. So also there is a new contender, Superior Life Sciences, is entering the contrast media space in Q2 fiscal year 2026. Blue Jet has enjoyed a near monopoly in India for contrast media, but the competition is heating up. If Superior Life Sciences is officially knocking on the door with their own API pipeline, then it will be a huge risk for Blue Jet Healthcare. Also, we need to highlight that while Blue Jet has superior margins historically, their cash conversion cycle is nearly 262 days, is much slower than peers like Ami Organics, which is now Acuitas Chemicals, or Aarti Pharma Labs. So while Blue Jet is more profitable on paper, they are asset heavy in terms of time. It takes them almost 9 months to turn recover inventory into cold hard cash. That's much slower than the leaner peers. And unlike many mid-cap peers who carry debt for expansion, like Aarti Pharma Labs, Blue Jet is doing 1,000 crore Vizag expansion purely on internal accruals and cash reserves. So Blue Jet is taking a massive bet on a new plant without borrowing a single rupee. It's a high stakes, zero debt strategy you won't see in many other stocks. Hope you like this video. If you do like the video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.